Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
All right. Today we've got Ben Murphy with us. Ben is a seasoned multifamily broker. We are excited to hear some of his opinions today. Ben, do you want to just introduce yourself a little bit to our audience?
Sure. Well, AJ and Chris, I appreciate you having me back on. It's been at least maybe 2.5 years. A lot has transpired in that span of time. So I'm excited to kind of go over this with you guys. I've been a broker about 12 years, multifamily space in the Portland area. We work all over the state as well as Southwest Washington. Initially with Tilbury Ferguson Investment Real Estate. Liz and I parted ways in early 2024. I now work with a company called Commercial Integrity Northwest, and I'm the director of multifamily for that company. And yeah, excited to chat with you guys today.
You also own what, 25 or 40 units, or?
I'm up to 40, Chris. Don't shortchange me.
No, sorry. I said 25 or 40.
It's okay. You were right. And nothing compared to the Uptown portfolio, but we all got to start somewhere, right? I still believe in investing in blue states. Very long-term is the best way to go. And I have no plans to sell anytime soon. So as a broker, buying real estate, I think the smart ones do it over the long run. There's so many tax advantages. So, I mean, this isn't news to you guys, but that does help me having a little bit of an owner perspective too, to kind of share when I'm prospecting.
Yeah, I'm excited to chat a little bit about blue states, and as well, you have some red state marketing market perspective as well.
I moved to Dallas about a year and a half ago now. Wow, and I'm splitting time between Dallas and Portland, so definitely a unique. It feels like I'm living in two worlds. Currently, I'm 99% still Portland based as far as my transaction volume, but long run, I did just get licensed in Texas. So we want to kind of have more national exposure through our firm to buyers and investors. So we thought having kind of a Sunbelt presence was a good move for our firm long term. So that was kind of the idea behind that.
I feel like the Sunbelt and the Pacific Northwest kind of have a, like opposite market cycle almost. It's very interesting. Like when Portland was booming in, 2017, 18, like Atlanta and I think I wasn't hearing much about Texas. Austin was blowing up, but I feel like the market cycles are, there's some nice balance to being, Sunbelt and then Northwest.
I mean, I think all the markets kind of, trend in directions, but it does seem that like the Pacific Northwest might be a little offset. Like either we're early or we're late in some instances. Like you were saying, the Sunbelt, kind of just getting discovered to 2015 to 2018 and really ran up. While we were kind of in our boom.
It's interesting when you look at the West Coast, guys, because it's more consistent. Yes, we're in a downturn right now, and I think we will be throughout 2026, and I think we'll bottom out this year as far as commercial real estate values. But generally speaking, if you look at like Texas or Florida or even Phoenix, or some of these more urban sprawlish type markets that have so much supply that delivers in a short period of time, you see cap rates expand and contract at a pace that is, 3x, 4x what we're used to seeing in Portland or Seattle or San Francisco. Not to say our markets don't have ups and downs. Obviously they do, but it's more severe in these other regions. So part of my reason for loving investing in blue states is the consistency there.
And I think that's really correct. When Chris and I first started investing, we got in at 2007, like top of the market. But luckily we were only buying like one or two at a time then. But we definitely noticed, and like we knew of people buying stuff at auction down in Phoenix, and it's like really like boom or bust. I mean, they were buying properties that were for 20, 25K at the auction, and normally would be going for, at that time, 200 to 300K. So it just that supply that comes in the Sunbelt with less regulations and everything like that really does play into the market, and really plays into buying existing product and the value of it.
Yeah.
I mean, AJ, you bring up an interesting point of the oversupply from 2004, 5, and 6. And that all played out through, a huge debt crisis. We're kind of experiencing, a similar, maybe not as big of an oversupply, but without the debt crisis. And so we're lucky we don't have a debt crisis because, yes, credit is certainly a lot tighter. It's harder to get loans. I mean, honestly, my experience with Freddie Mac, basically any bank, is that they promise you something and then they cut your proceeds, 10 or 15% and say, take it or leave it. Whereas during boom times, they're like, how much money do you want?
Yeah. The lending climate, everybody was like pretend and extend, right? And then we can say survive till 25, and here we are in 2026. And we haven't seen the distress, the systemic distress that I think a lot of the commercial real estate market was expecting. Portland has some office towers and stuff, but that have gone back to banks, but there's nothing like, we're multifamily guys, right? All of us here. And generally speaking, there's a handful, you could probably count them on one hand, of like Class A apartment deals that have gone back to the bank in the last couple of years in the Portland market. But looking at the grand scheme and size of our market, that's a very minuscule proportion relative to the overall product. So it's interesting because I know in other markets it's a much higher level, at least from what I'm hearing. So
that is a great anecdote. I feel like we've hit some anecdotal feelings about the markets. Ben, you mentioned that you came with some hard data. At least when it comes to prospecting and in a couple other areas. I'm excited to hear it.
Yeah. So, we use a CRM. It's just a Salesforce product, but I kind of reflected before this call on 2025 and I'm a numbers guy, and I'm a believer, like, if you can't look back and kind of quantify things, it's hard to really goal set for the next year and understand kind of where you want to be as a broker. Personal goals aside, this is purely kind of professional goals. So I use this to kind of set my 2026 kind of aspirations. So I look back and I had made 2,985 cold calls. Of those calls, that led to 93 BOVs, fancy acronym for evaluation. So just a free property valuation we do for owners. Of those 93 BOVs, that led to 18 listings. Of those 18 listings, we closed 10 deals, so a little over 50% close rate. And then of those 10 closings, 4 were actively listed, 4 were off market, meaning we brought an unsolicited offer from a buyer, and it was right place, right time, and we closed the deal. And 2 of those were buy side commissions. So I guess dissecting those 10 closings and unpacking that a little further, the total sales volume on those 10 deals was 45,840,000, total of 260 units. Aggregate price per unit was 161,841. getting really granular here, guys. And cost per foot was 215 a foot. And the cap rate, this is an in-place cap rate on current rents, not pro forma, was 5.65%.
5.65. That is much higher than what we thought we'd be selling at, 5 years ago.
Totally. And I should preface this with, I compared this to my last 12 years. I've got an Excel spreadsheet, and I would say for kind of a decade there, like 2014 running up through 2020, 2021, so maybe 8 years, I looked at the average cap rates for each year on all the deals I've closed, and they were generally between 4.5 and 5. And you saw kind of 50 to 75 or so basis point increase 2021 till now. Maybe 50 to 100 basis points. So yeah, the last 3 or so years.
I mean,
Transaction
that's a
volume is down
25%.
too.
Sorry, say that again, Ben.
Sorry, Chris. The last one was transaction volume was down. I look back over that time span, and it was like I typically close 75 to 100 million dollars a year, and I'm about 45 million this year. So kind of half of my normal volume.
And my understanding from kind of like all the economic reports, seeing Multifamily Northwest and some of the other like national guys, like transactional volume across the nation was down like 75% in 2023, 2024. I think 2025 it's climbed, but certainly I don't think we're back to, the transactional volume we saw pre-COVID.
Yeah.
Would 23 and 24 were those years also lower transaction volume?
I can tell you right now.
Because I mean, anecdotally, it feels like it was impossible to sell anything. I mean, we still have one property that we're trying to sell that we listed in 2023, and the deal we eventually closed with you, we also listed that in 2023, our 9-plex in Tualatin, which probably didn't bring up your average, but we did sell it for over 200K a door, so we had a lot of square footage on those.
Yeah, so 2024, I closed, like my volume was 67 million. So it was a little bit higher than 2025. The cap rates were a little lower, 5.4%, 151 a door, average price per door. But going back to the peak, for example, like 2020 average cap rate, on my closed sales, 5%, 2019 was 5.3%, 2018 was 4.9%. So we've seen a pretty rapid expansion in cap rates. And I don't think a lot of people anticipated such an adjustment.
Yeah, I mean, nobody predicted interest rates would rise so much, and they're not directly correlated, but it certainly limits the buying power of and the ability of buyers. With interest rates higher, you've got to lower your loan to value, which means you got to come up with more cash. So they're related, but not directly correlated.
And owners, I mean, Chris, you touched on this earlier with credit kind of being locked up. Like if you can't refinance to fund capital improvements, whether it's plumbing or electrical or roofs or windows or siding, or B, buy another deal, which most people can't, right? Who wants to give up a 3 or 3.25 rate early, right? That's why we're seeing such stagnant, transaction volume, right? And people really avoiding the older vintage assets.
Well, there was also the insurance just reshuffle. I mean, we experienced it with American Family exiting the Portland market, and we had to find new insurance carriers. And essentially, it just led to us having to pay 50% more in insurance. And so, you're talking about cap rates, but as well, I guess what isn't reflected in the cap rate is the huge expansion in expenses. Not only have, are your profit, your net operating income dollars worth less, but you're getting less of those net operating income dollars because utilities, I think I looked at it and utilities are up 75% in the past 5 years, and insurance is up 50%. I mean, the cost of labor is significant. The only thing that's not really up are management fees because they're just a percentage of the income. And it's just so interesting that it's so like, I mean, yeah, properties aren't going back to the bank, but they're worth significantly less on paper.
Yeah, I mean, NOI is eroding, right? If you have rent growth that's muted at 3 to 5% a year, and for Portland, that's low relative to the last decade. And in many cases, rents are flat. If you're at market, rents are probably more flat. If you're a bit under market, you're still seeing maybe 3 to 5% annual growth, but then expenses are going up, I don't know, 8 to 10% annually. So double. Yeah. And you combine it with higher borrowing costs. Yeah. That's why values are down 30 to 40%.
So Ben, kind of like given all this information and what you talked about, 2026 bottoming out, like, I guess kind of what substantiates that opinion?
Yeah, I guess, well, first of all, I'm a broker, so I'm a glass half full kind of guy, but I think I think that the supply glut is something that is serious, and rents have to rebound purely from a supply standpoint. Portland historically had 8 to 12,000 units coming online a year in the MSA. And I think right now we have 700 in the planned and proposed phases. So a fraction, 8 or 10% of what we normally see. So from that standpoint, to get NOI growth back, we're going to need to see rent growth, obviously. And I think that will happen purely from a delivery, like a new unit delivery standpoint, and very limited planned and proposed product in the pipeline. I also think that rates are going to come down, maybe 50 or so basis points this year. And if we normalize around 5 instead of 5.5, that does move the needle quite a bit. And I think we're seeing a resurgence in people. I'm hearing this from investors and buyers being skittish of those red state Sunbelt markets that are currently really struggling to absorb a ton of supply.
I mean, Portland is struggling to absorb supply for sure.
But it's all relative, right? Our amount of units is minuscule compared to some of these other markets.
Interesting. I mean, I guess we were chatting about this yesterday at our quarterly meeting. We saw an article that said that there's 2,000 affordable units that are sitting vacant. It's almost, I think it's like 7 or 8% of the affordable, homes available in the area out of the 25,000. And it's just like, and that's most of that product is new. And like just looking at those listings and the concessions that are being offered, like 2 or 3 months free and rents capped at, like $1,300 for a new 1-bedroom and like $1,450 for a new 2-bedroom with huge concessions. And
I mean, given the fact that, Home Forward came out with a letter saying no rent increases, I mean, they're probably not adding more people into the program. So those things are probably going to sit vacant, or, maybe some of those Section 8 vouchers move around. But ultimately, unless they move from a market rate, property into the affordable, like that absorption is probably going to stick around for quite a bit of time just because there's not going to be new applicants would be my guess.
I also think there is a lack of tenants that qualify.
Yeah, that's probably true too.
Part of that issue, when you look at the income threshold to rent at some of those projects, I mean, that's a guess, but I know enough about tenant screening and kind of where rents are, but the letter, AJ, you mentioned is interesting. I've had multiple owners bring this up in the last few months.
I read another thing today that it actually says that that we're not allowed to raise rents on these Section 8 people, according to that letter. So, which it just boggles my mind. I can't imagine that as a, landlord that's required to allow Section 8 in to then, allow them in, and then we can't screen off of it. So we can't deny them just because of that fact. But then they can come back and tell us that we can't raise rent on them. I mean, I think that's something that's probably going to have to get handled out in the courts by someone. And unfortunately, the court process is going to take way too long. Then, so it just won't come into effect.
It's unfortunate. I'm sure your market rate tenant would also love to not have their rent increased.
Yeah, right.
It doesn't seem too fair. Yeah.
Well, Ben, while we got you here, we had our quarterly meeting yesterday, and we started syndicating around 2020. So we got some more properties that we're, going to have to probably dispose of in the coming years. And, we sold the 68th with you, earlier this year. And that was, our first kind of 1031 through a syndication. That was a new process for us. We were super excited to take some investors with us onto the next project. But from asset standpoint, like what sort of advice or kind of recommendations can you give us with regarding to financials, actually physical attributes of the asset to like really poise it for a good sale?
Yeah, I mean, CapEx or, trying to achieve a highest new rent, possibly with a bunch of concessions.
Yeah.
Just go with like what really moves the needle when it comes to like, is that highest achieved like that big of a deal? Or yeah, let us know.
I would say illustrating upside, but leaving something out for the next guy, some meat on the bones. So if you could, and some of this is out of your control because you have more turnover than you're expecting or what have you. But if you can renovate, like I've had the best luck when owners renovate like a quarter of the units, 25 to 30% of the units. They illustrate a rent that, is 30 to 40% higher than the average in place rent. And there's kind of proven upside and a track record that the broker selling the deal can point to. But honestly, we're in a rental market right now that will pay more for a unit that's well managed, safe, clean. It doesn't have to have all the bells and whistles. And I guess what I mean by that is you need to be really careful right now to over improving your units. I think, the age of like throw in granite and, all new cabinet boxes and appliances and tile backsplash and, like the full shebang, like that, like there's the ROI is not there right now for that. So I would say be judicious about your turns. You will get a good 25 to 30% bump, spending $5 to $8 grand a unit and not going that full blown 20 to 25 and almost gutting and redoing all the finishes. Proving that high rent out on maybe a quarter of the units, having clean books and records and avoiding delinquency and aged receivables as much as you can is really important as well. Lenders are extremely just picky about delinquency.
I'm kind of curious about the, quality of the renovation that you talked about. I mean, our outlook is we've always been long-term investors. I mean, do you think that that is a myopic view given like the circumstance that we've been in for the last like year, 2 years? But as you know, supply you mentioned is probably slowing down and absorption's, going to be up. Like the differentiating, and maybe not, this year, but maybe next year, or maybe the following year, like those granite countertops and that other thing might be a large differentiator in rent as it once was.
I mean, yeah, I think right now it's just managing expenses. Like, I think the best thing a property management firm, and you guys are vertically integrated with Uptown, which is great. So you kind of like, you're driving the bus and you've kind of got like different tranches in your company. So you're able to like manage the renovations, manage the property. But I think placing good tenants in your buildings that pay rent on time. Yes, you may not be getting tippity top market rent, but focusing less on making the units really, really nice. Because the problem is when you spend all that money on a rehab and a renovation, what I found is a lot of owners sacrifice the quality of tenant. They kind of like they have to settle for somebody that might on the face level say they're going to pay that rent and they stop paying, or there's an eventual eviction, and it just destroys operations. So I would say,
Is that because of the price of the unit? Because say we've put, 20, 30K into it and we're expecting a larger rent bump, then there's less applicants.
that's part of it.
And
But
then you
also,
have to sacrifice the quality of the tenant because there's less people applying.
correct. I mean, the price point is part of it, the rent level, but the other part of it is like there's going to be pressure on you guys as the operator to rent that unit quicker when you know you have $20,000 to $25,000 of cost to recoup. And naturally, I found owners and management companies sacrifice whatever it is in screening the tenant just to get somebody in there. So that can come back to bite you on an operations side. And I've seen it really often where people over improve units. They end up kind of doing a heads on beds type leasing approach. And it's tough to operate through that. And it snowballs from there. It also helps to show like, look, we rented a unit for 1,600, a 2-bedroom unit, highest achieves 1,800. Let the next guy deal with that, right? Like everybody wants some form of upside. And a lot of times the buyer will pay you for that upside and you don't even have to go to the work to prove it out. And in prove it out, I mean, have all of your rents at that level. You can illustrate it's achievable, but it's not like you have to show, look, every unit's remodeled. I can get 1,800 across the board.
So the having, the one or two units with like the highest achievable is pretty important, like before disposition.
Yes, I would say so.
Like, I guess maybe what sort of timeline, like if we're looking at disposing something, how early should we be kind of like looking at, these sort of things?
Yeah, I mean, typically, I mean, that's kind of that's a tough one to weigh in on as far as,
Well, I mean, like from our perspective, we, getting the highest achievable rent right now in the middle of winter, like this is just not going to be our best outcome, right? Whereas like if we wait until May or June and, we select like one of our best units and like try to get that highest achieved, then we come into, winter or even next year where we can say, hey, maybe we list it next January or something and hopefully have a sale complete by May or June the following year.
yeah, seasonally, I've had the most traction every spring, and that hasn't changed in 12 years of doing this. So I'd say if you are flexible from a timing standpoint, hitting the market in like March, April for kind of blasts in late spring, early summer is the best approach. Yeah.
So it's like thinking about it the prior summer. So thinking about it from like July until September, like starting to think like, how are we going to position this asset so that like, we're entering in with a broker maybe December, January and like listing what, like February, March? Like what's kind of like, from what you've seen, like the ideal situation?
Yeah. I mean, it takes us about a month to get all the marketing material together typically. And then, we usually actually blast it out in an email like, a month thereafter and start doing property tours. So, I mean, there's no like set formula, AJ. Every owner's different. It, yeah. I mean, I think to the extent, like, are you, I mean, this is a question I would pitch back to you guys. Are you even doing 9.9% right now on turnovers?
I mean,
No.
with tenants that we don't want, like, yes. We're also trying to gear people towards leases, so we will put in a higher rent increase on a month to month and then offer a lower rent increase for a lease. But I mean, I want to say we're seeing somewhere between like 2 and 7%, depending on the asset.
Well, I mean, if we have a unit that's $500 under market,
Yeah, I mean, those are
one
outliers,
of the
right?
deals, the deal in Milwaukee that you sent us or sold us a year and a half ago.
No, nobody's moved out of that one.
With the rents, the 2-bedroom rents at $900. Yes, we're doing 9.9 over there. We've got a few units where we have 10 years of 9.9 rent increases scheduled out. But aside from those, anybody who's within 10 or 15% of market rent, we're sending a small increase. We're really trying to avoid not increasing or decreasing the rent, but sometimes it's very, very small.
In kind of like all the property management realm that I've been in, and even advice from our dad was like, it doesn't matter what happens. Like you want to train your tenant to expect receiving something. Like even if it's a nominal increase, like a 1% or a 0.5%, like the setting them up and training them that like every year, like our taxes go up, our insurance goes up, everything goes up. So like even just that it's going to be something. Because I mean, that's where I think you get these, some of the properties that you sell or bring us is like, these self-managed people are like, oh, I don't want to be diligent with the property management. Like it covers the mortgage. I'm making money, I'll just like let it ride. But really just being diligent about, having them get used to something.
Yeah. Ben, I have a couple questions. So, there's a lot of different like versions of the language of how to achieve the highest sales price, price per door, price per square foot, cap rate. I mean, but in the end, when someone's selling a property, they want to get the most that they can out of it. And so how do you navigate the language when it comes to deciding how to choose which way to, I guess, advertise it or which way to, yeah. And then I guess I've got a few more questions, but I'm interested in that right now.
So we try to look at it through the buyer's lens, right? And generally speaking, if I can illustrate cap rate aside, because cap rate's subjective, right? Everybody thinks they can get certain rents. Maybe they can, maybe they can't. Everybody underwrites expenses. Sometimes they use actuals for utilities and taxes and insurance typically, and then often they'll estimate the other stuff. So it's like the cap rate can change a lot, whether you're a buyer, a seller, a broker, a lender, whoever. But looking at it through the buyer's lens, I would say if I can illustrate north of a 7% unlevered yield on cost, generally I can get traction with buyers. Unlevered meaning we're not factoring in debt or leverage. And that's basically just looking at the cash. I guess another way to look at it would be the like cash on cash return for, day one when you purchase an asset. So taking the NOI divided by the cash flow after the debt service divided by the initial investment, which would be your down payment plus all your loan fees and closing costs. So if you can be 7% or higher, generally I've found that is a way to back into pricing that's realistic.
And that wouldn't include any CapEx costs, right? That's just literally for purchasing the property.
Correct. That would be below the line. So that's, assuming standard operating expenses. Yeah.
And now here's a word from our sponsor. Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
And so if there is deferred maintenance, the calculus gets a little more complicated.
It does. So I guess, yes, you would have to sort of budget for those non-recurring CapEx items. So that 7% number is assuming there's no deferred maintenance. When there is deferred maintenance, it typically means there's like way more upside. So you kind of got to look at it. The formulas get a little different, right? If you're completely redoing the building envelope and enhancing the curb appeal and spending $30,000 a door on that, it's very likely you're going to get much higher rents too. So sometimes those offset each other, right?
And so, when you have an older asset that, can, I guess that, you could spend a lot of CapEx on. When it comes to getting a property ready for sale, like when you don't have a huge budget and you're selling something as a value add, what are the small things that move the needle, I guess, in the eyes of a buyer that should get done prior to listing?
I would say, yeah, low-hanging fruit for a seller who's kind of on the fence or looking at like how to maximize value in the near term: signage, landscaping, exterior lighting, paint, trim, right? Paint, like in the grand scheme of things, it can be expensive, but striping a parking lot or even doing like a slurry coat, can really, really help. Tree trimming. Yeah, a lot of this is more exterior related. I think, yeah, those are a few that come to mind.
It seems like all of that stuff would also increase rents. If it's more like visually appealing, if the exterior is more visually appealing, like if the paint is crisp, there's good signage and good lighting at night, that would seem like, it might pay for itself.
I agree. And what I've found is owners who kind of judiciously watch costs, but improve the curb appeal, the kind of common areas, when they're delivering those rent increases on lease renewal, the tenants are way more receptive because they're seeing we're all getting a mutual benefit here. Right? I'm not getting a rent increase because you renovated my neighbor's unit, right? I'm getting a rent increase because the general appeal, safety, the cleanliness, of the property I live at is improved. So I found operations wise, as far as maximizing income, those are kind of great ways to position an asset for sale. Those kind of low hanging exterior items I mentioned.
Yeah. I mean, even if you're not selling, making sure that those items they're being paid attention to. I mean, I'll throw in like gutters, having clean gutters, especially if it's raining, clean roofs. Yeah.
Privacy fencing has been really good.
Mhm.
There's some, depending on the location, like a security gate too, but yeah, like, little private, like smaller things, if you're filling in a pool too, like barbecue areas or a dog run, like that has been really well received too. So
Interesting. We had a lot of success creating private fenced areas at one of our properties. And that,
Yeah, the newest one that we bought, we're planning on putting in the fenced areas. It's just what we found on that deal, which was awesome, was that our common area landscaping reduced as a cost, and the value to the tenant went up. So pushing that, the cost of the landscaping by enclosing it to the tenant made a big difference, and it was a good project.
are you planning to fully enclose it, or is it partial, sort of like side by side, kind of quasi private backyards?
For the new one that we did on Cloverleaf, there's actually no backyard access, so we have to remove a window and put in a sliding glass door, and we'll
Oh, wow.
fully enclose a backyard for each unit that's on the ground floor. And there's a significant amount of area that is land so I mean they'll actually be like fairly good sized backyards, and people that have pets love that ability rather than, having to, get out of their PJs and put on shoes and, get out from under the TV to go walk their pet.
and you get to charge pet rent too. So or instead of charging pet rent, it just more easily garners a higher rent. And I guess one of the things that we found in Portland is that people love their pets. And if you don't accept pets, then that really limits the tenant pool.
Yeah, and again, I think I've seen at property inspections, unit walkthroughs at no pet properties, the quality of tenant is horrible. So you're kind of giving up. Can you collect a larger security deposit or no?
Yeah. Yep.
So
Pet
there's ways
deposits.
to mitigate that risk. Pet rent, security deposit, that stuff helps miscellaneous income. So yeah.
So I think you really kind of dived into the physical attributes of the asset, but can you give us some examples of like what you've seen on some financials, and like what suggestions you've made to people to kind of like get the properties books ready for sale?
Yeah, I would say, everybody has a little bit of a different definition of CapEx. And I think it depends on your bookkeeper and your, your CPA and your kind of risk tolerance. But I'll just kind of go like general, like middle of the road here on what I'm used to seeing and what I recommend to owners. But if you're if you're redoing a unit with all new like LVT or LVP flooring, like I've seen a lot of people put that below the line. Obviously like windows, roofing, siding, plumbing, electrical, all should be shown below NOI. Cleaning up aged receivables is huge on the income side. And I've actually had some owners, I've advised them to pay off debt prior to going into marketing. So there's not some $10,000 or $15,000 balance due. Not everybody agrees, but it has come back to.
When you say pay off debt, you mean either evict a tenant that has a large past due balance or forgive it.
Forgive it.
Yeah, it are. What about past tenants? I mean, when it comes to, I guess, aged receivables, are most of the time we're not sending. It's only current tenants that we send aged receivables for to lenders, at least.
Correct.
I guess I should rephrase this comment on delinquency because I've actually done it two ways. We've also handled it when we're in escrow, having the owner pay the buyer the balance due prior to going for loan app to clear that up. So it's not showing on a 30, 60, 90 day plus day AR with a bunch of back due rent. That basically that tenant's timeline has started over. It's been forgiven. So we've done it that way as well. But Chris, your question was, I forget.
Well, I mean, when it comes to current tenants that have aged receivables, like whether it's utilities or rent, you know, the options are to either forgive that tenant's rent or aged receivable, or to evict them, or I guess just, you know, keep sending them collections notices. We haven't strategized that at all. And so I guess I'm interested to hear, I guess, a little more on the conversation. I guess from the lending perspective, you know, if there's large past due balances, it shows, you know, that, I mean, I guess that just shows that there's, you know, there's gross potential rent available. I guess, you know, when you show the actual historical number, the amount of money collected, you know, I mean, most deals I'm underwriting right now, you know, I'm taking a very hard look at the actual rent received in the past 12 months, as opposed to, you know, taking a hard look at the rent roll.
I mean, what are eviction timelines right now in the city of Portland?
So it's a few months.
Crazy thing is Multnomah County has gotten better than Washington County, which is like
Multnomah's like
flip-flopped. It's like
60 to 75 days.
As an investor, we're like, yes, we want to buy stuff in Washington County specifically because the length of the timeline was less. And then now, you know, things have gotten stretched out. And it's just an example of like how, you know, some operational changes can really, you know, be a detriment to the, like, you know, the investment. Sucks.
So if we're positioning a deal for sale and you've got somebody that owes $10,000 in back due rent, you file an eviction on them, they'll be out in, let's say, 3 months. What are the chances that you do, so you do evict them eventually, right? What are your chances you're getting those funds back when you send them to collections?
Like 2 or 3%?
Minimal, very minimal.
Less than 5%.
Small, less than 5%.
So my point, I guess, in thinking about positioning assets, and I've talked to owners about this, and some people are agreeable, some are like, no way, but is why don't you forgive that rent when we're thinking about positioning it for sale and say, look, you have a clean slate, but a contingency or condition of me giving this to you is that you're going to be paying your rent going forward.
I mean, that, you know.
Are there any legislative or landlord-tenant law issues with an agreement like that? See, I'm not the property manager. I'm just thinking as the broker outside the box, but that's something I've told owners as well. Maybe something for you guys to think about.
Honestly, you know, at a first appearance for an eviction, you can create a stipulated agreement with the tenant. And essentially, you know, you can be like, hey, I will forgive your rent as long as you pay, you know, going forward on time.
So you have a double benefit. The AR goes away.
AR goes away. They start paying, but then if they violate that agreement, you can evict them immediately. You don't have to wait for another trial. That's a pretty powerful
bargaining tool.
Yeah, I mean, if you can do that stipulated agreement at the courthouse. I recently attended a first appearance in Washington County, and our tenant, who hasn't paid rent since December, said that he wanted 5 months or $10,000 in cash to vacate. I wish I would have said, all right, we'll forgive your rent as long as you pay, going forward. And
Yeah.
I guess I wonder how long that stipulated agreement could last for,
It's something to think about. And I think in positioning an asset for sale, if you do have some delinquency that, is going to hurt us and probably whittle away at loan dollars, that's a creative thing to think about.
Yeah, because those first appearances, you can get them in a couple months, or sorry, in a couple weeks. So usually it's 15-ish days from when you file for eviction. And so if you can get creative on those, yeah, that's a powerful I guess idea or tool that I thought a little bit about, but I mean the way that from your perspective, that's huge. Cool. Well,
What other stuff on the P&L? I mean, we recently kind of have been discussing the like ancillary management fees and putting that as income on the P&L.
What do you mean by ancillary management fees?
Late fees and what other like lease break fees?
NSF fees,
That,
non-compliance fees.
that should always be miscellaneous income.
Yeah. Yeah, it's
I mean,
money
you
guys
received
might
from
enter-
tenants.
Typically, our management contract stipulates that goes directly to the management company, but showing it on the P&L and then additionally as a cost shows a higher rent or a higher income, even though it still goes way on the cost.
Yeah, I mean, I would definitely love to see you guys clean that up and show, late fees, security deposit forfeitures, pet rent, whatever other miscellaneous income items, all above, yeah, on the income side of things. What else?
I mean, I know that we show RUBS, utility income and then utility payments, so it's kind of something similar to that.
Conservice and these third-party billing companies are well worth the nominal per unit fee you pay. I don't know if you guys do it directly or use a flat fee or if you use a third party.
Nah, we do it ourselves.
we
We've got
use Rubs.
we've got accountants that do it.
Okay.
But it has come back to bite us, on the sending of notices and just like the groaning of the entire complex of switching from either flat fee or some mishmash of systems to billing based on square footage.
Yeah, I mean, nobody likes to change, so whenever you implement a change, there's always some friction. Doesn't matter what it is.
I just know with like Conservice, that's the one that most property management firms use. I want to say they charge like $1.50 a unit a month to handle everything. And all the liability and risk is shifted onto them if there's a screw up with, disclosures or like paperwork or notices. I don't know. I mean, I haven't read this contract, but I've heard from other owners that their capture rate that they get for water, sewer, garbage is much higher than what they were previously getting using like a flat rate or a square footage or an occupancy
Yeah,
formula. That's just what I've heard.
that's interesting. I mean, yeah, that's super interesting. And so do you think that having Conservice is, I guess, more valuable than something that is implemented by a property management company because it's, I guess, more plug and play?
Yes, like it's easier to transfer.
Yeah.
So from a sales standpoint and maximizing value, I would say yes.
Okay. What about like laundry, and just that situation?
On-site laundry versus washer dryer hookups.
No,
Well,
just on-site laundry.
say you're using coin meter and like, they take, 40%, right? Like, do you show the 100% income and then the 40% payment to coin meter? Like, is it worth it to bolster the income and then show the cost of like what it costs to pay their contract?
Or should you buy them out of the contract and then show 100% income?
Honestly, laundry income is so minimal in most cases. I don't necessarily see it really moving the needle. But you guys have a lot of smaller plexes and kind of properties that are, in that 4 to 10 unit range. And if they do have on-site, I guess since it's a smaller complex, it does make up a larger, I don't know if you would agree with that, but
I mean, the last deal that we just did, that the laundry income bolstered the proceeds by, I want to say it was like 100 grand.
Actually, no. Chase said, we know you're getting laundry income. We're just not going to use it.
it's actually really common for lenders just to completely ignore miscellaneous income as well. Not everybody, but yeah, I'm not surprised.
Yeah. All right. So laundry, what about other?
But I mean, if lenders don't look at it, but the buyers that are looking at the P&L when you present it to them, like they're the ones that are really making the decision, right?
That's a good point, AJ. Yes. And I would say buyers will almost more often than not give you credit for that.
Right. I mean, and that's probably the reason to put like, the pet rent and the miscellaneous like late fees and other income on the income line. Just larger cash flow kind of bolsters the value of an asset, even though the NOI stays the same, but showing that you've got more cash flow. It's got to add to a little bit of the leverage, doesn't it?
Yeah, it does.
Ooh, I have one slight aside. So, as far as like upgrading an older building, what upgrades make sense right now? Like where are you actually, how can you transition a, C minus building to either a C plus or a B plus or B minus?
I mean, didn't we kind of go over this where his opinion is like not doing the B minus and going more for the C plus of like painting the cabinets and spending.
Well, that's interiors, but I mean,
are you asking like if we're, there's
like storage, what if there's space at a property, is it worth it to create storage?
If you have a property that's close in the inner city with mostly studios, yes. Generally in the suburbs, it's a waste of time. Suburbs close in, where you have more 2-story garden style, like 1 and 2 bedroom floor plans. I've very rarely seen storage. If it's like over 20% occupied, I'm surprised. As far as interior light rehab, it would be flooring, LVT, light fixtures, plumbing fixtures, respray the Formica counters. It's like $250. You can make it look really clean. It almost is hard surface looking without being a hard surface, but it looks clean. Cabinet fronts and paint and trim. But again, avoid, the heavy interior renovation expenses. And then exterior wise, we sort of touched on it already. The fencing, the landscaping, lighting, roofing. Well, you said clean gutters, which I agree with too.
Functional gutters, not ones that are overflowing.
Yeah, probably dealing with stormwater.
Definitely. I think that can come back to bite you as far as like washout and like erosion and crawl space mitigation work.
Yeah.
Yeah. But as far as like, like making changes to floor plans or adding in-unit washer and dryer, that like digging more. I mean, that to me, the adding in-unit washer and dryer is that moves the needle for tenants.
It definitely does. I mean, that will significantly enhance your leasing and give you a leg up to most of the competition in your immediate neighborhood. But again, it boils down to what's the return on cost there. First of all, can you vent it? Second of all, does that involve an electrical panel upgrade? Likely it does. And third,
Permits.
where does it fit?
Yeah.
Yeah,
Not to say
where
you can't do it, but those are kind of three really big hurdles that can cause costs to go through the roof.
I got another kind of question, maybe a little bit similar. Chris and I are, I wouldn't say arguing, but we have maybe a difference of opinion. The deal that we just bought, there's 3 2-bedrooms and 2 1-bedrooms on the ground unit, and so we're putting in these fences for all 5 of them, no matter what. We're gonna have to pull permits for those because we're changing a window to a door. But the the laundry room is next to. It's in between each of the 1 units. And so there's 4 buildings total. So we, had this idea to remove 2 of the laundry rooms and add a bedroom to each of the 1-bedrooms, turning it into, instead of 6 2-bedrooms and 4 1-bedrooms, to 10 2-bedrooms. So, increasing the square footage of 4 1-bedrooms and increasing them to 2 bedrooms. I mean, probably overall cost, like the actual construction of it, is minimal. Like, it's putting up a wall and demoing some storage and putting in a door. The cost really comes in on the architectural and the permitting. So, I mean, my kind of like guesstimate is like 80 to 90K to do all 4 units.
I think you need to quadruple that with the structural upgrades and the bringing in, and we'll have to do like ADA requirements and
No. I've talked to the architect about that. There's no ADA requirements. It's underneath the threshold, and we're already going in for permits for the fences and the doors. So this would just be kind of an add-on. So I might even be high on like some of the architectural costs because they're, we have some sunk cost in already doing these fences and putting the doors in. And so the additional cost to do these like 4, upgrades to 2 bedrooms.
all right, let's just call it 200K.
No, like not even. Like, that's
So
a joke.
you're saying it's 90?
Yes, 80
An
to 80 to
additional
90.
90. So you're saying we can add these 1-bedrooms for less than $100 a foot?
Yes.
That seems like, but AJ, you're the architect kind of engineer background, so I'm not questioning you. I would just say be very diligent and make sure that whoever comes out from the city or the county, I mean, somebody's going to inspect it, right?
Yeah.
And often, are they going to require like fire suppression sprinkler upgrades?
We've got an architect that is super familiar with the city of Portland, works with them all the time. And because there's 10 units in each building, because there's another 5 up the top, we're not modifying more than like 20 or 30% of the building. Like, we're literally taking. What's that?
Are you changing the use in the city's eyes or no?
No, it's it's a laundry room that's common area accessible by everyone, and it's just changing it from common to private.
So yeah, because the number of units isn't changing.
No. Yep.
That's what would maybe trigger. Okay.
But still, the question is, we'd be removing half of the laundry rooms, and
yeah, they'd have to walk, 50 yards extra down to.
And then,
but they the way that it's set up, configured currently, is their doors are on one side of the building, and then the door to the laundry room is on the back side. So they already have to walk,
but
a third of the way there.
The question is is the 1-bedroom, does it ruin the unit mix? Is it worth it to, because I guess right now all of our 1-bedrooms are rented. It's the 2 and the 3 bedrooms that are impossible to rent. And that changes from time to time. So I think it's an interesting question.
That is interesting. I would think the 2s and the 3s would be more full in this market with the rental climate being what it is and people wanting to room up, right?
I mean, my guess is that with the 3 bedrooms, the comparable cost to an actual house and the amenities that you get to a house, like it's just, instead of being in an apartment that doesn't necessarily have like the full amenities of like a gym and like, the other stuff that's associated with it, the 3 bedrooms in our apartment complexes are very difficult right now. I don't necessarily agree that our 2 bedrooms are that much harder than the 1 bedrooms, but the jump from the 2 to 3, I think is pretty significant.
Well, AJ, assuming you're willing to sign on the dotted line for Chris that it won't be more than $80,000 to $90,000, I think it would make sense.
At what price does it not make sense?
I'm nervous about that. I mean, I think it could be easily double that, but again, I'm just the broker. That sounds light, but you guys self-perform on a lot of this stuff, and I've seen you save costs in other.
Well, I mean, but like it's directly next to the units, right?
Yeah,
so you have to put in one interior door, and then you have to put in a demising wall in between the laundry room, and then you have to demo what's already in there. Like the actual construction is not a lot. Like the more cost of the construction is going to be changing the window to a sliding glass door. Like that's going to be a much more significant cost than like the actual like adding of the bedrooms.
Yeah.
I'm not saying that the entire project is going to be 80 to 90K. I'm saying that particular portion of the entire project is probably 60 to 85K. But you'd say it'd be worth it for that price.
Yes.
Yeah.
To remove laundry, which is kind of generating like maybe $200 a month, those laundry rooms. And
all 4 units, it was like $500 a month. So each laundry room itself would be like 125, 150.
It was for the 3 months that it was about.
And also, Chris, just because you remove a laundry room doesn't mean that the laundry actually doesn't happen, right? Like they're just going to move locations. And so that income is not necessarily lost.
You may need to make sure you can add a machine or 2 in the other rooms if you need it.
Yeah.
If there's space.
And it would be interesting to consider, having those units be in-unit washer and dryer in the ones that we converted. And potentially adding that to the adjacent units as well.
Because they're next to the laundry room, so they have
that increases SDC fees, because then you're adding plumbing fixtures and everything else. Like that adds a significant cost. Like
I thought SDC fees were free.
No, SDC fees are waived for new units, not upgrading existing units and fixtures.
But it wouldn't be adding fixtures; it would be repurposing them.
Correct. That you could repurpose it for the 2 upgrades, because I believe that there's 2 washers and 2 dryers in there. So you keep those fixtures and just move them within those 2 1-bedroom units that you're increasing to 2-bedroom units. So I mean that could be potentially part of the plan. But the adjacent 2 bedrooms, I wouldn't foresee that being a good idea to especially add washer and dryers to the other units, especially with the crawl spaces being demised. Like this particular property has a separate crawl space for each unit.
Whoa.
Yeah.
Well, Ben, as always, I mean, honestly, we could probably just keep going for,
We've actually got to get going.
We can just keep going forever. I swear, every time I get you on the phone, it's just like, oh shoot, my next appointment is now.
It's feelings mutual, my friend. I'll see you next week. So
yeah, poker night.
Yep.
Oh, fun. I'm sorry, I'm gonna be missing it, but I wish you guys the best of time. I hear it's your birthday.
It's Arch. It's his son's birthday.
Oh. Okay.
Yeah.
We'll sing. We'll do a video message for Archer.
There we go.
And send it to him. Well, hopefully with a giant stack of money in front of us.
There we go.
Cool. Well, Ben, it's been an absolute pleasure chatting with you. We've got your answers on our last 4 questions from your previous podcast. So this one's gone a little bit long too. So I think we're going to pass on those for this episode. But is there any parting kind of like wisdom that you want to give our listeners, or if people have some more, want to talk to you more about the Portland market, or the best way to get a hold of you?
Yeah, I would say just go to my company website, Commercial Integrity Northwest. Again, my style of brokerage is I try not to be pushy. A lot of my clients and owners and the people I'm prospecting are big boys and girls, and they can make their own decisions. But I want to be an advisor first, and whether it leads to a sale or a commission down the line, and hopefully it does eventually. I'm just an open book, and I genuinely really just enjoy relationships and kind of molding those relationships. And the Uptown one is a great example where we've become good friends too out of it. And if you ever want to get a hold of me, all my contact info is on the website, cell phone, email, and we can hop on a call. But yeah, we'll leave it at that.
Awesome. Well, thank you very much for coming on the show and sharing your knowledge and wisdom about the market. I know I learned a few things today.
Good.
Yeah.
Thanks, guys.
Thank you so much, Ben.
All right.
Bye-bye.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.